Welcome to Topical Economics. If you are new here, don't forget to subscribe and hit the bell icon so you never miss any of our insightful videos on key economic concepts. In today's video, we're diving into the topic of firms, costs, revenue, and objectives. I'll be walking you through some past paper multiple-choice questions, carefully analyzing each one to explain why the correct answer is what it is. Whether you're preparing for exams or just want to strengthen your understanding of economics, this video will help you get to grip with important concepts in a clear and practical way. So, let's get started. Starting with the first question. A bank continues to operate loss-making branches. Which objective is the bank trying to achieve? A. Growth. B. Efficiency. C. Profit maximization. D. Social welfare. Reference, 2022 May-June version 2. The objective the bank is most likely trying to achieve by continuing to operate loss-making branches is option D. Social welfare. Banks may keep certain branches open, even if they are not profitable, to serve the local community or provide financial services to underserved areas. This can be part of their commitment to social responsibility, ensuring access to banking services for all customers, regardless of profitability. Option A, growth, typically focuses on expanding the bank's market share or assets, which is unlikely if branches are losing money. Next, option B, efficiency. If a branch is making a loss, continuing its operation would generally not be considered efficient from a financial perspective. Lastly, option C, profit maximization. A loss-making branch would not align with the goal of maximizing profits, as it is costing the bank money. So, in this case, the bank may be prioritizing social welfare over immediate profitability. Moving to question 2. The diagram shows the fixed costs, variable costs, and total costs of a firm at output S. Costs. Which distance represents the firm's variable costs? Reference, 2022 May-June version 1. The correct answer for this question is option D. QS represents the firm's variable costs. Moving to question 3. The table shows a firm's costs for producing bicycles. Which statement is correct? A. The average cost of producing 4 bicycles is $15. B. The average fixed cost of producing 2 bicycles is $20. C. The total fixed cost is $10. D. The total variable cost of producing 3 bicycles is $50. Reference, 2022 February-March version 2. The correct answer for this question is option A. Average cost is equal to total cost divided by the number of bicycles. For 4 bicycles, we can say that the total cost is $60, so the average cost will be $60 divided by 4, giving average cost of producing 4 bicycles as $15. Moving to question 4. The table shows output and total cost of a firm with 4 production methods, A to D. Which method causes diseconomies of scale as the firm expands production from 1,000 to 3,000 units? Reference, 2021 October-November version 3. The correct answer for this question is method B, because diseconomies of scale typically occur when average costs begin to rise as output increases. However, based on the options and the given data, none of the methods show diseconomies of scale as output increases, all show either economies of scale or constant returns to scale. Moving to question 5. The diagram shows total cost, TC, total fixed cost, TFC, and total variable cost, TVC. Which costs are shown by W, X, and Y? Reference, 2021 October-November version 3. The correct answer for this question is option B. W represents the total cost. X represents the total variable cost and Y represents the total fixed cost. Moving to question 6. A firm imports 20 high-quality bicycles into the U.S. at a cost of $3,000 each. It sells them all, making a profit of $1,000 per bicycle. What is the firm's average revenue? A. $1,000. B. $2,000. C. $3,000. D. $4,000. Reference, 2021 October-November version 3. The correct answer for this question is option D. The firm's average revenue is calculated by dividing the total revenue by the number of units sold. In this case, the firm imports 20 bicycles at a cost of $3,000 each and sells them for a profit of $1,000 per bicycle. This means the selling price of each bicycle is $3,000, cost, plus $1,000, profit, which equals $4,000. Since the firm sells all 20 bicycles, the total revenue from the sale is $4,000 per bicycle times 20 bicycles, which totals $80,000. Average revenue, which is the revenue per unit sold, is simply the selling price per bicycle, which is $4,000. Therefore, the correct answer is D, $4,000. Moving to question 7. The table shows the average total cost of a firm over a range of output. What happens after 4 units are produced? A. The firm experiences management problems. B. The firm gains the benefits of merging with another firm. C. The firm pays lower interest rates to banks. D. The firm receives significant discounts from bulk buying. Reference, 2021 October, November, version 2. The correct answer for this question is option A. The firm experiences management problems because the data from the table suggests that the firm's average total cost decreases as production increases from 1 to 4 units, indicating that the firm is benefiting from economies of scale. Its average cost is decreasing as it produces more. However, after 4 units of output, the average total cost begins to rise, which is a typical sign of diseconomies of scale. Diseconomies of scale occur when a firm becomes less efficient as it expands production beyond an optimal point. This inefficiency can often result from management problems, such as difficulties in coordination, communication, and oversight as the firm grows larger. As a result, the firm may face higher costs due to factors like reduced control over operations, slower decision-making processes, and lower employee productivity. Thus, the increase in average total cost after 4 units of production is most likely caused by management challenges, making option A the correct answer. Moving to question 8. The diagram shows the total cost curve for a firm. What can be concluded about the firm? A. It has no fixed costs. B. It has no variable costs. C. Its average fixed cost increases. D. Its average variable cost is constant. Reference, 2021 October, November, version 2. The correct answer for this question is option D. Constant AVC implies that the total cost curve increases at a constant rate as output increases. This would be the case if variable costs increase linearly with output, leading to a constant average variable cost. If the total cost curve is a straight line with a uniform upward slope, it would indicate that the firm's average variable cost does not change as output increases, hence, AVC is constant. Analyzing the other options. Option A. It has no fixed costs. While it's true that the total cost curve might not start at a positive value on the cost axis, which would suggest no fixed costs, we would need more information to definitively conclude that there are no fixed costs. If the total cost curve starts at 0, it is more likely that fixed costs are indeed absent. Next, option B. It has no variable costs, would imply that the total cost curve is flat, i.e., there's no change in cost with output, but a slope indicates that variable costs exist. Lastly, option C. Its average fixed cost increases, is incorrect, because average fixed cost, AFC, decreases as output increases, since fixed costs are spread over more units. A rising total cost curve does not indicate rising fixed costs, only that variable costs are increasing. Moving to question 9. For some months, the price of petrol, gas, decreased significantly. How would this affect a delivery firm that delivers goods for other firms using petrol, gas, powered vehicles? A. Average fixed costs would decrease. B. Profits would decrease. C. Total fixed costs would decrease. D. Would decrease. Reference, 2021 October-November, version 1. The correct answer for this question is option D. Variable costs would decrease. A delivery firm that uses petrol-powered vehicles incurs variable costs for fuel, which change depending on the amount of petrol used. If the price of petrol decreases significantly, the cost of fuel per delivery will be lower, reducing the firm's total variable costs. Since the cost of petrol is directly tied to the quantity used, which depends on the number of deliveries made, a reduction in petrol prices will lower these costs. Analyzing the other options. Option A. Average fixed costs would decrease. Fixed costs, such as rent, salaries, etc., do not change with the amount of fuel used or the number of deliveries made. Average fixed costs might decrease in the long run if the firm increases its level of output, but this is not directly related to the decrease in petrol prices. Next, option B. Profits would decrease. A decrease in petrol prices would generally lead to lower costs, which, all else being equal, would increase profits, not decrease them. Lastly, option C. Total fixed costs would decrease. As mentioned, fixed costs are not affected by the price of petrol, so this would not be the correct answer. Moving to question 10. The table shows the average revenue of a firm at various levels of output. What happens to total revenue as output rises? A. It falls and then rises. B. It falls continuously. C. It rises and then falls. D. It rises continuously. Reference, 2021 October-November, version 1. The correct answer for this question is option C. Total revenue is price multiplied by the quantity. We can see that. From 1 to 2 units, total revenue rises from $10 to $16. From 2 to 3 units, total revenue rises from $16 to $18. From 3 to 4 units, total revenue falls from $18 to $16. Thus, total revenue rises initially and then falls after a certain point, from 3 to 4 units. This pattern suggests that total revenue increases and then decreases as output increases, which indicates the firm is experiencing a decreasing marginal revenue beyond a certain level of output. Moving to question 11. Dimitri owns a firm that produces and sells bottles of lemonade. He only sells one size of bottle. How would Dimitri calculate the total revenue of the firm? A. Multiply the quantity sold by the cost per bottle. B. Multiply the quantity sold by the price per bottle. C. Multiply the quantity sold by the profit per bottle. D. Multiply the quantity sold by the tax per bottle. Reference, 2021 May-June version 1. The correct answer for this question is option B. Multiply the quantity sold by the price per bottle. Total revenue is calculated by multiplying the quantity of goods sold by the price per unit, in this case, the price per bottle of lemonade. This gives the total amount of money the firm receives from selling its product. Analyzing the other options. Option A. Multiply the quantity sold by the cost per bottle. The cost per bottle refers to the firm's production cost, not the selling price. This would give the total cost, not total revenue. Next, option C. Multiply the quantity sold by the profit per bottle. Profit per bottle is the difference between the price and the cost of the bottle. Multiplying by the profit would give total profit, not total revenue. Lastly, option D. Multiply the quantity sold by the tax per bottle. The tax per bottle is not related to the firm's total revenue directly, it's an additional cost or tax charge that might affect profits, but not revenue. Moving to question 12. A firm employs 10 workers. Each worker is paid a weekly wage of $200 and produces 50 goods per week. What is the average cost of labor per good produced? A. 40 cents. B. $4. C. $20. D. $200. Reference, 2021 May-June version 3. To calculate the average cost of labor per good produced, we first need to determine the total labor cost and the total number of goods produced. The firm employs 10 workers, each earning a weekly wage of $200, so the total labor cost is 10 workers times $200 per worker, which equals $2,000 per week. Each worker produces 50 goods per week, so the total number of goods produced is 10 workers times 50 goods per worker, resulting in 500 goods per week. To find the average cost of labor per good, we divide the total labor cost by the total number of goods produced, $2,000 divided by 500 goods, which equals $4. Therefore, the average cost of labor per good produced is $4, making B, which is $4, the correct answer. Moving to question 13. Which cost of production falls continuously as output increases? A. Average fixed cost. B. Average total cost. C. Average variable cost. D. Total variable cost. Reference, 2021 May-June version 2. The correct answer for this question is option A. Average fixed cost. Is the total fixed cost divided by the quantity of output produced. Fixed costs, such as rent or salaries of permanent staff, do not change with the level of output. As output increases, the total fixed cost is spread over more units of output, causing the average fixed cost to decrease continuously. Analyzing the other options. Option B, average total cost, ATC, is the total cost, fixed plus variable, divided by the quantity of output. While average total cost may initially decrease as output increases due to spreading fixed costs, it typically starts to increase again after a certain point due to increasing marginal costs. So, it doesn't continuously fall as output increases. Next, option C, average variable cost, AVC, is the variable cost per unit of output. Average variable cost typically decreases at first as production becomes more efficient, but after a certain level of output, it starts to increase due to diminishing returns, so it does not continuously decrease. Lastly, option D, total variable cost, TVC, represents the total variable cost incurred by a firm. It increases with output since variable costs depend on the level of production. Therefore, it does not decrease as output increases. Moving to question 14. What describes the total revenue of a firm? A. Fixed costs plus variable costs. B. Income from sales minus total costs. C. Quantity of goods sold multiplied by unit price. D. Variable costs divided by output. Reference, 2021 May-June version 3. The correct answer for this question is option C, quantity of goods sold multiplied by unit price. Total revenue refers to the total amount of money a firm receives from selling its goods or services. It is calculated by multiplying the quantity of goods sold by the price per unit. This gives the firm's total earnings from its sales before accounting for any costs. Analyzing the other options. Option A, fixed costs plus variable costs, describes the total cost of production, not total revenue. Total costs include both fixed and variable costs, but they are separate from the firm's total revenue. Next, option B, income from sales minus total costs, defines profit, not revenue. Profit is the difference between total revenue and total costs. Lastly, option D, variable costs divided by output, represents average variable cost, not total revenue. Average variable cost is the variable cost per unit of output. Moving to question 15. The diagram shows the total revenue, TR, and total cost, TC, of a firm in a market. At which level of output will the firm maximize profits? Reference, 2021 May-June version 3. The correct answer for this question is option B. The profit-maximizing level of output is the one where the vertical distance between the TR curve and the TC curve is greatest. This is usually where TR starts to grow more slowly, or the TC curve starts increasing more sharply, indicating that additional units of output are no longer contributing to a higher profit. Moving to question 16. What is calculated when price is multiplied by the quantity demanded of a product? A. Average revenue. B. Profit. C. Total cost. D. Total revenue. Reference, 2021 May-June version 2. The correct answer for this question is option D. Total revenue is calculated by multiplying the price of a product by the quantity demanded, or quantity sold. It represents the total income a firm earns from selling its product, before any costs are subtracted. Analyzing the other options. A. Average revenue, is the revenue per unit of output, which is calculated by dividing total revenue by the quantity of output. It is typically equal to the price when a firm sells a single type of product at a constant price. Next, option B, profit, is calculated by subtracting total costs from total revenue. It is not simply the product of price and quantity. Lastly, option C, total cost, refers to the overall cost of production, including both fixed and variable costs. It is not calculated by multiplying price by quantity demanded. Thank you for watching this video. I hope the explanations of past paper questions and the reasoning behind the correct answers helped clarify some key concepts. If you found this video useful, please don't forget to like, comment, and subscribe to Topical Economics for more insightful lessons and exam tips. Your support is truly appreciated, and it encourages me to keep creating valuable content to help you succeed. Feel free to leave any questions in the comments, and I'll be happy to assist. Thanks again for being a part of the Topical Economics community.